All right, let's get right into it. We're looking at a fascinating story today, a real classic investment dilemma. What happens when a fantastic, top-quality company suddenly just falls off a cliff? Well, that is the story of Gabriel India.
Just imagine this for a second. You're holding a stock that everybody loves, it's a market darling, and then, bam! In just 6 trading sessions, it plunges by a jaw-dropping 25%.
So, you have to ask the big question. What on earth happened here? Was this a warning sign that something was seriously wrong inside the company? Or was the market completely missing the bigger picture? Let's figure it out.
First things first, let's just appreciate how sudden and dramatic this whole thing was. We're talking about a serious, fast decline that had investors hitting the panic button.
I mean, look at those numbers. The stock just went into a freefall. A full quarter of the company's value, gone in the blink of an eye. That kind of move, that fast, is exactly what causes widespread panic. Now, to really understand why that drop was such a shock, you gotta know who Gabriel India is. This is not some small, speculative company. These guys are an absolute titan, a king in their field.
And here's why. They are India's #1 maker of suspension systems. You know, the shock absorbers in your car or bike. And the key here is how diversified they are. Their money isn't just coming from one place. It's spread all across the auto world, with a huge chunk, 64%, coming from 2- and 3-wheelers. And in that massive 2- and 3-wheeler space, they have a commanding 32% of the market. They are the go-to supplier for all the big names. Now, this part is really important. In the aftermarket, we're talking about the replacement parts business, which has great profit margins. Their grip is even tighter. They've got a 40% market share. That's a super steady, profitable business for them.
But here it is, the most unbelievable number of all. In the world of heavy-duty trucks, commercial vehicles, and even railways, they have what is basically a monopoly. We're talking an 89% market share. That kind of dominance is almost unheard of.
Okay, so market dominance? Check. But what about their performance? Let's pull back the curtain and look at the financials, because this is why investors were so in love with this stock before everything went south.
So these are the results from right before the stock took a nosedive. Revenue was up a very healthy 15%, and profit was up 10% from the year before. See, this wasn't a company that was struggling. By every normal measure, the engine was firing on all cylinders.
And this is the kind of stuff that defines a high-quality business. Return on equity over 20%? That's fantastic. A balance sheet with absolutely zero debt, that gives them incredible strength. And on top of all that, they reliably pay dividends to their shareholders. It just ticks every single box. All right, so if the company is so powerful and its finances look so good, it brings us right back to that burning question. Why in the world did it crash 25%? Well, this is where we start to see the first cracks appear in that shiny armor. And the first big, flashing red light was its valuation. This slide says it all, really. Gabriel was trading at a price-to-earnings ratio of 71. The average for everyone else in their industry was less than half that. This meant investors were paying a huge premium, basically betting on years of perfect, uninterrupted growth. There was absolutely no room for error.
And then an error showed up. The thing that actually tipped the scales and started the sell-off came from one of their big new growth plans, a venture into making sunroofs. The market had massive hopes for this.
And then they heard this. Right on their earnings call, management basically said, you know that huge revenue target we had for the sunroof business? Yeah, it's probably going to be delayed by a year or two. For a stock that was priced for absolute perfection, that tiny dose of reality was all it took to send people running for the exits.
So it seems simple, right? A delayed project spooks the stock that was way too expensive, case closed. But what if that was the wrong story? What if the market, in its panic, was focusing on a tiny detail and missing a truly massive development happening right under their noses?
Behind the scenes, this was happening. It's called a composite scheme of arrangement. I know, it sounds super technical and boring, but the idea is actually pretty simple. Gabriel's parent company was planning to take several of its other really successful businesses and merge them all directly into Gabriel. This wasn't just a minor adjustment. This was a plan to transform Gabriel into a much bigger, much more powerful company.
Here's how it works, in 2 simple steps. First, the parent company bundles up all its best auto-related businesses into one big group. Then, in step 2, that entire powerhouse of a group gets absorbed by the publicly traded Gabriel India. Simple as that.
And the results of this move, well, they're staggering. Just look at the before and after.
Revenue is projected to jump by up to 60%. Profit margins get a big boost. And for shareholders, their earnings per share could increase by up to 35%. And check out that last line. Gabriel goes from being just a suspension company to a much broader, more diversified powerhouse.
Okay, so let's put it all together. You've got these two completely different stories crashing into each other. On one hand, you have a short-term panic about one project's delay. And on the other, you have this massive, game-changing transformation happening at the very same time. And that's our dilemma.
So this is the whole thing in a nutshell. The bull case is clear. You've got market leadership, a rock-solid balance sheet, and this incredible restructuring that promises huge growth. But the bear case is just as clear. That's sky-high valuation, the fact that the stock is volatile, the real delay in the sunroof business, and of course, the auto sector just goes up and down.
And that leaves us with this one final question to think about. When a great company is in the middle of a massive transformation like this, one that's set to create so much value, did the old rules about valuation even apply anymore? Maybe paying that premium price isn't a risk. Maybe it's just the price of admission to get in on the ground floor of something much, much bigger. It really is the ultimate question of quality versus price.